Hey everyone and welcome. If you've ever looked at a stock chart and felt completely lost or wondered how traders seem to predict price movements, you're in the right place. Today, we're diving into the world of technical analysis, what it is, why it matters, and how you can start understanding what those price charts are actually telling you. Now, before we jump in, let's talk about who this is relevant to. We're primarily focusing on the US market, stocks, ETFs, maybe some crypto if you're interested, but the core principles apply pretty much anywhere you find tradable assets. Whether you're a complete beginner or you've dabbled in investing but want to level up your understanding, this video is for you. So what is technical analysis? Simply put, it's the art and science of studying past price and volume data to forecast future price movements. Unlike fundamental analysis, which looks at the underlying health of a company, things like earnings, revenue, and debt, technical analysis focuses solely on the price action itself. Think of it like studying the patterns of a heartbeat to understand a person's health, instead of looking at their diet or exercise habits. Now, some people dismiss technical analysis as just looking at lines on a chart or even voodoo, but it's actually based on a few key assumptions. The first is that market prices reflect all available information. This is known as the efficient market hypothesis, and while it's debated, the idea is that everything known about a stock is already baked into the price. Secondly, technical analysts believe that prices move in trends. And finally, that history tends to repeat itself. Meaning, patterns that have formed in the past are likely to reappear in the future. Let's look at a really simple example. Imagine you're looking at a stock chart and you notice that the price has been consistently making higher highs and higher lows. This is what we call an uptrend. A technical analyst would interpret this as a sign that buying pressure is stronger than selling pressure, and the price is likely to continue moving higher. They might then look for opportunities to buy the stock, anticipating further gains. Now let's flip that around. If the price is consistently making lower highs and lower lows, that's a downtrend. This suggests selling pressure is dominant, and the price is likely to continue falling. A technical analyst might look for opportunities to sell or even short the stock, anticipating further losses. But it's not just about identifying trends. Technical analysts also use a variety of tools and indicators to help them interpret price charts. One of the most basic is support and resistance. Support is a price level where the stock has historically found buying interest, preventing it from falling further. Think of it like a floor. Resistance is a price level where the stock has historically faced selling pressure, preventing it from rising further. Think of it like a ceiling. Let's say a stock has been bouncing around between $50 and $60 for weeks. $50 would be considered a support level, and $60 would be considered a resistance level. If the price breaks above $60, it suggests strong buying momentum and could signal a further price increase. Conversely, if the price breaks below $50, it suggests strong selling momentum and could signal a further price decrease. Another common tool is moving averages. These are essentially lines that smooth out price data over a specific period of time. They help to identify trends and potential support and resistance levels. A simple moving average, SMA, calculates the average price over a set number of days. For example, a 50-day SMA would add up the closing prices of the last 50 days and divide by 50. Now, it's important to understand that technical analysis isn't foolproof. No one can predict the future with 100% accuracy. There will always be false signals and unexpected events that can impact price movements. That's why it's crucial to use technical analysis in conjunction with other forms of analysis, like fundamental analysis, and to always manage your risk. Think of it like being a detective. Technical analysis provides you with clues, patterns, trends, support, and resistance levels, but it's up to you to piece those clues together and make informed decisions. It's not about finding a magic formula that guarantees profits. It's about increasing your probability of success. To recap, Technical analysis is the study of past price and volume data to forecast future price movements. It's based on the idea that market prices reflect all available information, that prices move in trends, and that history tends to repeat itself. We've covered basic concepts like uptrends, downtrends, support and resistance, and moving averages. Remember that it's not a perfect science, and it should be used in conjunction with other forms of analysis and sound risk management. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.